On a quiet Tuesday last month, a single wire transfer cleared for $400 million. It wasn't for a skyscraper. It wasn't for an oil rig. It was for a warehouse in Northern Virginia filled with silicon chips. If you look at the stock market today, everything looks perfect. The S&P 500 is hovering near all-time highs. Tech earnings are beating expectations. The narrative is clear. The AI revolution is here, and it is profitable. But if you look at the debt fueling that market, you see a very different story. We are looking at the largest divergence between stock prices and collateral value in financial history. We are financing 20-year infrastructure projects with assets that become obsolete in 18 months. It's a $600 billion gamble. And here's the paradox. If you read the quarterly reports of the biggest tech companies, this debt barely exists. The math doesn't add up. Right now, for every $1 of revenue generative AI creates, the industry is spending roughly $4 on infrastructure. In any normal business cycle, that's called a burn rate. Eventually, you run out of cash. But big tech isn't running out of cash. In fact, their cash piles are growing. So, how are they paying for the most expensive construction boom since the interstate highway system? They aren't. They are using a mechanism that Wall Street perfected in 2007. It's called off-balance sheet financing. They take the debt, package it into a separate company, and sell the risk to someone else. This isn't illegal. It's smart accounting. But the debt didn't disappear. It just moved. It moved into the shadows of the financial system, into the unregulated world of private credit. And this brings us to the uncomfortable question. Who holds that debt now? It's not the banks. The entities holding the bag for the AI build-out are the same entities that hold your retirement savings. Public pension funds, insurance companies. They are chasing yield in a low-return world. But what happens if the AI returns don't arrive fast enough? What happens when $1 trillion of debt needs to be refinanced, but the collateral backing it is worth zero? We aren't here to tell you the sky is falling. We are analysts, not alarmists. But we need to explain how a rule passed 15 years ago to save us from a crash might have just set the stage for the next one. But before we look forward at how this mechanism works, we must look back. Because we have seen this movie before. In the late 1990s, the world went crazy for the internet. Companies like Global Crossing and WorldCom borrowed billions of dollars to lay fiber optic cables across the oceans. They believed internet traffic would double every 100 days forever. They were wrong. When the dot-com bubble burst in 2001, those companies went bankrupt. Investors lost everything. But here is the crucial difference between then and now. When WorldCom went bust, the fiber optic cables stayed in the ground. They were physical assets with a lifespan of 25 years. We are actually still using some of those cables today to transmit this video. The current AI boom is different. We aren't laying cables. We are buying chips. If you bought a state-of-the-art Nvidia chip in 2023, it cost $30,000. Today, just 2 years later, it is already considered legacy hardware. By 2027, it will be e-waste. This is what economists call the depreciation cliff. In the dot-com era, the collateral, the cables, retained value. In the AI era, the collateral, the chips, evaporates like an ice cube in the sun. And yet, the debt used to buy those chips stays on the books for years. This mismatch creates a structural fragility that is distinct from previous financial cycles. To understand the risks sitting on balance sheets today, we have to look at the unintended consequence of the Dodd-Frank Act. After 2008, the government forced big banks to stop taking massive risks. If a bank wanted to lend $1 billion to a speculative tech project, regulators effectively said no. This made your checking account safer. But here is the reality of capital. It behaves like water. If you build a dam, the water doesn't disappear. It just flows around the wall. When banks stopped lending to risky ventures, private credit exploded to fill the void. But who are these lenders? Unlike a bank, which you can walk into, Private credit firms operate in the shadows. They are often called shadow banks. Firms like Blackstone, Ares, and Blue Owl have grown into trillion-dollar giants. They operate logically. They raise money from investors, and they lend it to companies that banks won't touch. Usually, they lend to software companies with high margins. It's a great business. But AI infrastructure is not software. It is heavy industry. It requires land, steel, copper, and cooling systems. Normally, you would use project finance for this, the kind of safe, boring loans used to build bridges or toll roads. Those loans pay low interest rates because the risk is low. But AI is high risk. So, these data centers are paying high interest rates, sometimes 10, 12, or 14%, to get the cash quickly. Why would anyone pay that? Because they have no choice. Here is the math problem. If you are a data center paying 12% interest on your debt, you need to make massive profits just to break even. If the price of AI compute drops, which it will, because technology always gets cheaper, your profit margin collapses. But your interest payment stays exactly the same. This is the margin squeeze. And it is the specific mechanism that usually triggers a wave of defaults in high-yield debt markets. And at the exact moment this new financial industry was born, Silicon Valley entered the most expensive arms race in history. In 2024 alone, big tech's capital expenditure crossed $200 billion. By 2025, it nearly doubled. Now, here's the problem. Even for Google, spending $50 billion a quarter burns through cash reserves fast. They needed leverage. But remember the dam? The big banks couldn't lend them that much for speculative tech. So, the tech giants turned to the water flowing around the dam. Private credit. We are seeing a historic partnership. Big tech partners with asset managers like Blackstone, KKR, and Apollo to finance this build-out. Think of it like this. You want to renovate your kitchen, but you don't want the debt on your credit report. So, you get a wealthy partner to take out the loan. You promise to pay them rent. To the world, you are debt-free. But in reality, you are on the hook for massive monthly payments. The scale of this kitchen renovation is astronomical. We are building the equivalent of the interstate highway system in 4 years. The assumption holding this together is that AI will be profitable enough to pay the rent. If AI generates trillions, this debt is a footnote. But if the revenue is delayed, if we hit a trough of disillusionment, that debt becomes a heavy chain. So, how exactly do they hide hundreds of billions of dollars? They use the round trip. And it's perfectly legal. Let's strip away the jargon and look at how the money moves. There are 2 mechanisms fueling this. The first is the revenue round trip. Here is the scenario. You are a massive cloud provider. You have expensive GPU chips sitting idle. You need to show investors growth. So, you take $1 billion of your own cash and invest it in an AI startup. The AI startup takes that $1 billion and gives it right back to you to buy cloud computing credits. Wait, pause. Did you catch that? You booked $1 billion in revenue. You have a strategic investment asset, but no new money entered the system. You just moved money from your left pocket to your right pocket. This creates a feedback loop. Higher revenue drives the stock price, which allows more investment. It works beautifully, unless the startup burns through its cash before finding a sustainable business model. The second mechanism is the collateral trap. When you get a mortgage, the house is the collateral. Houses last 30 years. Now, imagine taking a 30-year mortgage on a smartphone. This is GPU-backed lending. Lenders are issuing billions in loans using the chips as collateral. But silicon chips follow Moore's law. An Nvidia H100 chip loses 40 to 60% of its value when the next generation launches. We have a duration mismatch. The loans are for 5 to 7 years. The assets are obsolete in 2. If a borrower defaults in year 3, the lender opens the warehouse and finds a pile of silicon that is technically worthless compared to the loan value. The lender is left with a hole in their balance sheet. And remember, these aren't banks with federal insurance. Why would financial pros take this bet? Yield. In a world of 5% returns, these loans pay 12 or 14%. It's a race against depreciation. If the AI boom accelerates, they win. But if there is a slowdown, the math breaks. But while the money is theoretical, the power consumption is physical. We are running out of electricity. To train a single large language model like GPT-4 requires the same amount of electricity as 1,000 US households use in a year. And that is just for training. Running the model takes even more. In Virginia, which is the data center capital of the world, the power grid is already approaching its maximum capacity. Tech giants are now buying nuclear power plants. Microsoft is restarting 3 Mile Island. Amazon is buying nuclear capacity in Pennsylvania. Think about that. A software company buying a nuclear reactor. This intense demand for power suggests that the easy growth phase is over. When you have to build a nuclear reactor to keep your business growing, your capital costs increase significantly. You are no longer a software company with 90% margins. You are a utility company with huge overheads. This changes the valuation models. Wall Street is currently valuing these tech giants like they are infinite money printers. But as they hit the physical limits of the power grid, their growth must slow down. And if growth slows down, stock valuations often readjust. And when valuations readjust, the collateral backing all that debt loses value. It is a domino effect that starts with a power line in Virginia and ends with a margin call in New York. And if these private credit funds take a loss, who actually loses? It is easy to view this as a casino game played by giants. But in finance, risk tends to flow toward the liquidity providers. Who gives private credit funds their money? They raise it from institutional investors. That is a fancy word for pension funds and insurance companies. Pension funds need 7 or 8% returns to pay retirees. Safe bonds don't pay enough. So, they allocate billions to private credit. If you are a teacher or a municipal worker, a portion of your future is likely lent out to a data center project in Arizona. If those loans go bad, the pension fund faces a shortfall. States usually fix shortfalls by raising contributions or cutting benefits. This isn't a systemic shock that happens overnight. It's a slow squeeze on your future purchasing power. The impact is also physical. Data centers are energy hungry. They pay a premium for 24/7 power, prompting utilities to upgrade grids. But the cost of those upgrades is often spread across all ratepayers. In high-density tech regions, residential electricity rates are projected to rise faster than inflation. The AI boom effectively places an indirect cost on your monthly utility bill. Finally, there is the capital vacuum. Right now, AI is a magnet absorbing a significant portion of available global capital. Investors are so focused on the potential of tech that they are ignoring traditional sectors. If you are a small business owner trying to get a loan, you are competing for liquidity against the AI narrative. This is the opportunity cost. Trillions are locked in server racks instead of housing or healthcare. So, where do we go from here? History suggests 3 scenarios. Scenario 1. The soft landing. 30% probability. Revenue catches up. The killer app arrives. The debt is serviced. The system bends, but it doesn't break. Scenario 2. The liquidity crunch. 20% probability. Interest rates stay high. Collateral values tank. Funds gate withdrawals to prevent a run. This triggers a sharp correction in tech stocks. Scenario 3. The stagnation. 50% probability. No crash, but a decade of capital indigestion. Returns are low, and trillions remain trapped in infrastructure that yields mediocre returns. Now, a note of caution. Variables change. We are mapping probabilities, not certainties. So, how are smart investors managing this risk? Those concerned about the hard landing scenario are typically reviewing their exposure to the S&P 500, which is currently heavily concentrated in the very companies building this infrastructure. Many are diversifying into sectors that aren't reliant on GPU financing, like healthcare, consumer staples, or physical commodities to manage that concentration risk. The AI revolution is real, but the financial engineering used to build it is a highly leveraged structure that requires perfect execution. We've eaten a very expensive dinner. Now, we have to see if productivity can pay the bill. We are monitoring private credit spreads closely. As these numbers shift, we will update the analysis in the pinned comment below. I'm your host for FinRiseX Capital. Thank you for watching.